Ireland's government says it doesn't need a bailout, but growing doubts about the country's ability to pay its bills have sent interest rates there soaring. Forced to take over banks that suffered big losses from bad real estate loans, Ireland's debt is now 10 times higher than the EU ceiling. That's higher than Greece, which received a $145 billion bailout from the EU and the IMF earlier this year. Josef Ackermann, head of Deutsche Bank AG, says the EU needs to act quickly.
A breakout of any state on the markets right now would lead to contagion, and we want to avoid this with all means. We have to do everything to catch every country that runs into trouble.
Worries about Ireland's problems now threaten the creditworthiness of other high-debt nations such as Spain and Portugal. Those worries have pushed up borrowing costs, making it harder for some countries to pay down their debts. But some say the crisis has been exaggerated. European Monetary Affairs Commissioner Olli Rehn.
Let's not jump the gun. I mean, we are now engaged in short and effective consultations with the Irish government, together with the European Central Bank and the IMF, in order to assess the real situation.
Rehn says a $1 trillion fund set up earlier this year by EU countries and the IMF stands ready to help Ireland and other nations. British Finance Minister George Osborne also pledged additional support.
Ireland is our closest neighbour, and it's in Britain's national interest that the Irish economy is successful and we have a stable banking system.
Some say dealing with Ireland's debt is critical to the survival of the 16-nation Eurozone. But Frankfurt banking analyst Robert Halver says those fears are unfounded.
I would say Ireland will get some money sooner or later, and that's why there's no crisis.
Estimates peg the cost of bailing out Ireland's banks at nearly $70 billion, or roughly 30% of the country's annual output. The government says it has enough cash to operate until the middle of next year. Arcega, VOA News.